New York Community Bank is on the brink of collapsing. Their share prices crashed 60% to 1997 level. This is the bank that bailed out Signature Bank during the last year's regional banking crisis. But it's not just New York Community Bank. Other regional bank stocks are also plunging. Valley National Bank is down 25%, Metropolitan Bank is down 15%, HorborOne 14%, and the names go on. So what the heck is going on with these banks? In this video, we're going to dive into these banks' biggest risk, their exposure to commercial real estate. Also, at the end of the video, I'm going to share a list of banks with a significant level of commercial real estate loan portfolios. So if you have any money parked in one of these banks, you can consider getting your money out before it's too late. Before we go any further, if you can click the like button below and subscribe, it will help me out with this channel, which is still pretty new. Jerome Powell, the chair of the Federal Reserve, came out in a 60-minute interview and said some smaller banks will have to be closed or merged out of existence due to their losses tied to falling values of office buildings across the United States. He also said that he doesn't think there is much risk of a repeat of 2008. He believes that big banks are in a better position, even though many smaller regional banks have much concentrated risks in commercial real estate. Let's watch the clip and see what he says.
I don't think there's much risk of a repeat of 2008. Certainly there will be some banks that have to be closed or merged out of existence because of this.
Remember, Jerome Powell is a lawyer, so it's important to pay attention to his exact word choices. Him saying he does not think there's much risk of a repeat of 2008 is saying two things. Number one, 2008 could still happen, but it's just beyond his knowledge at the moment. And number two, there's still at least a moderate amount of risk of 2008 repeating. He said much risk, and that means a great amount of risk. And he's not lying if there's still a decent amount of risk of 2008 repeating. Commercial real estate in the US, particularly office buildings, are a huge part of the real estate market. According to Barry Sternlicht, the office properties in the US was once valued at $3 trillion, but now they're worth only about $1.8 trillion. So this $1.2 trillion loss is being absorbed by financial institutions at the moment. To provide you a context, the estimated loan and security losses from the 2008 GFC was between $1 and $2 trillion. A lot of different financial institutions came out with a different estimate of the loss, but IMF estimated at the time the loss to be around 1.4 trillion. So the losses from the current commercial real estate crisis is already similar to the 2008 GFC level. During 2008, these estimated losses kept getting revised upward as the time went on. And to add to this, we have 1.5 trillion of commercial real estate debt that is coming due before the end of 2025. Morgan Stanley said that refinancing won't be easy. And I agree with that because, who's going to refinance this debt when its value has collapsed? No one. I'm not a commercial lending expert, okay? But I do know that you can't refinance your home mortgage that is underwater. Who's going to refinance these loans originated at the value prior to the commercial real estate collapse? So when the office building's value is down by 50 to 60% and their loan is coming due in the next 12 months, that only means more bank failure and mass liquidation. And remember, a lot of these banks are also still underwater on treasury bonds, which is what caused the Silicon Valley Bank collapse last year. The Federal Reserve's Bank Term Funding Program, aka BTFP, will end on March 11th of this year. So what that means is that there won't be any more stimulus or loans for these banks, and they have to face the truth of their ugly balance sheets. And there's just no way that these smaller banks can absorb this kind of loss without going under, causing a serious ripple effect in our financial system. I remember back in 2007, New Century Financial filed for bankruptcy because of the mortgage crisis, and everyone thought it was just an isolated and contained incident. After exactly 1 year later, Bear Stearns happened in 2008. An interesting thing is that it's been about a year since Silicon Valley collapsed in 2023. We might be looking at a much serious problem in the banking sector in 2024, which is quite scary, to be honest. So now I'm going to share a list of banks that are in trouble. If you have a savings account or a CD with one of these banks, it's probably a good idea that you move some money around to a healthier bank. I know that not every bank is facing this kind of serious risk right now. Some larger banks are actually doing pretty well right now, and also depending on the level of their commercial real estate exposure, their risks are minimized, while for other smaller banks, they're only a few steps before a full-blown Armageddon. These banks have a commercial real estate concentration ratio of 300% or higher. The commercial real estate concentration ratio is calculated by dividing the outstanding commercial real estate loans by the total amount of capital the institution has. And regulators have defined the 300% ratio or lower to be a safer number, but once it's over 300%, banks are required to be scrutinized heavily by the Federal Reserve or FDIC to reduce its concentration risk. So on this website, this is bankregdata.com. Once you get there, there's a CRE/CONC, which means concentration. So when you get down to the list, you can organize the list by the amount of concentration in CRE. So if you click ratio, click again, it will sort the list by whoever has the highest CRE concentration. Yeah, look at this Valley National Bank at 474%, Flagstar Bank at 470%, Independent Bank 410%, and the list goes on. Just take a look at some of these banks on the list and see if you have any accounts with them. And I'm sure if you have less than $250K, which is the FDIC insurance amount, of course you're safe, but why even deal with that process if you can avoid it in the first place? So I would definitely go to this website to see if your bank is on this list. And if you have one of those high yield savings account, make sure who owns it. So for example, Exos Bank, I used to have an account with them. They own UFB Direct. So you can do some research to see if any of your savings account bank is owned by any of these banks here. And as you can see on the bottom of this list, there are some healthier banks. So like Discover, they own zero commercial real estate. American Express, mostly a credit card company, Barclays, Synchrony Bank, Sallie Mae, SoFi, their exposure to commercial real estate is very low. And also Ally Bank. Ally Bank has a very low exposure to commercial real estate, but at the same time, they have a heavy exposure to car loans. Auto loans is one of those things where things are already underwater on a lot of the cars purchased in the last couple of years. And that poses a significant risk as well. And this is another list. This is about a year old. While this other website, bankregdata.com, focuses on top 100 institutions by asset size, this other source right here, it lists banks that are even smaller. So take a look at this list, and you see this is organized by the CRE total to equity. This is basically the CRE concentration ratio. A lot of these banks have over 570% in the commercial real estate ratio, and that's not healthy. And US regulators recommend 300% or lower. So this is almost twice as much the regulators' recommended level for commercial real estate. So take a look and see if there's any banks here that you have an account with. And if you do, I would say go ahead and move some money around to a safer bank. By the way, I'm going to put links to both of these resources in the description section, so make sure you check that out too. Well, that's it for today's video. If you like this content, don't forget to like and subscribe, and thanks for watching.